Good morning, good morning. Let's do it, folks. Welcome to the Streets Opening Bell here from Post 35 on the floor of the NYSE. That is the New York Stock Exchange, in case you were otherwise a bit unfamiliar. Today is Wednesday, the 19th of October. I'm your host this morning, JD Durkin. Opening bell rung just moments, and I do mean moments ago, by Minerals Technology, ticker symbol MTX. This in celebration of the 30th anniversary of that company's listing. Congratulations to them. You'll see them here on the floor in just a moment. The story of the week is how the markets are riding the wave, have been riding the wave at least, of corporate earnings. Big beats from Goldman, Charles Schwab, B of A, all helping extend what is now officially a two-day rally, maybe a three-day. We'll see what's in store. But the fears of a recession are there, as are the fears of overly aggressive central banks. With that, let's now turn our attention to what is on tap for this trading Wednesday. We'll make sense of the two-day rally, what it means, and what should be at the top of mind for investors as we are getting new earnings data day by day, plus the latest housing and mortgage data, and finally Netflix with finally something to celebrate once again. Don't worry, we'll talk just a little bit of baseball before the broadcast winds down. For insights into those stories and so much more, we now bring in our senior editor and markets correspondent, the man who has been up, I think, all night. I don't think he ever sleeps, in order to bring our readers and now viewers at TheStreet.com everything they need to know. Martin Baccardax. Martin, good morning. Lest we forget, despite the gains of the last 2 days that we've had in this rally, the S&P overall still down more than 20% this year. First, let me get your impressions here. What is top of mind as we head into Wednesday after a pretty notable, what many people still refer to as a bear market rally, but a two-day rally nonetheless?
Yeah, I really think that it's a factor that is most linked to the solid earnings that we're getting in the early part of the third quarter season. And a lot of the stocks that outperformed were heavyweights on the benchmarks that we tend to track. So their outsized performance tended to lift the headline numbers and therefore give the suggestion of a healthier equity market. But ultimately, I think when we pick through these figures in the coming days, we're going to understand that it is very company specific as opposed to economy specific with respect to the strengths. And that may indeed add a headwind to what we're seeing. But to be perfectly honest, I'm surprised that we're holding up as well as we are in the early trade, because I think there was a bit of spook from the inflation figures out of Europe overnight. And we had, as a result, a big jump in bond yield. So ultimately, those macro headwinds aren't going away. And ultimately, as a result, we are probably going to be in thrall with the heavyweight stock names over the next 7 to 10 days. And then after that, I suspect we'll have a better indication of where the market's headed.
There doesn't seem to be a lot of optimism that we are in for a sustained rally. Is that your sense as well, that this may be just a continuation of another, which we've had in recent weeks, right? We've had these 1 or 2 day pops that seem to inject at least temporary optimism, but I think temporary is probably the key word there. Is that likely what we face in a week like this, you think?
Yeah, I don't see this lasting. I really don't, JD. And ultimately, we're going to have to look at exactly what the Fed reaction function is going to be to the faster than expected inflation prints that we saw in Europe, and whether or not they're going to filter through into our economy here in the United States. 10.1% was the headline figure in the United Kingdom. That's the fastest in 40 years. There was very modest moderation in inflation figures in Europe that went from 10% to 9.9%. That's still close to the highest on record. And it doesn't appear to be abating anytime soon. So if we get hot inflation prints beyond the November numbers, which will come after the Fed rate hike in November, on the 2nd or 3rd, I think, of November, then you can imagine further acceleration of bets on rate hikes going into 2023. As we stand right now, JD, there's a 73% chance of a fifth 75 basis point rate hike in December. That's extraordinary to me, because only a month ago, the expectation was only 8% for that 75 basis point rate hike. We're baked in for November, but now it appears that we're locking in another hike of the same size for the following month. That would take the Fed funds rate to 4.5%, and we aren't very far from getting to 5% and holding, unless we see a significant and sustained pullback in headline inflation figures, and that just hasn't materialized for a number of months now. So even with these stronger than expected earnings, it's going to be incredibly difficult for a tech-heavy benchmark such as the S&P 500 such as the NASDAQ, to outperform, even if the earnings come in more firmly than expected. And they certainly are at the moment. So I really feel that this rally, whilst welcome, and I would like it to be sustained, is going to face such significant challenges that I just don't see it building any momentum into the November rate hike, the midterms, and beyond.
I do want to get your perspective on some of those more headwinds, I should say. Hello, good morning. That we may face next year overall. JP Morgan's head of global macro research said next year, in other words 2023, we expect a more challenging earnings backdrop relative to current expectations. That seems to be a little bit of the mixed bag we see on a lot of these earnings calls, right? It's maybe the consumer is stronger in certain parts than we might otherwise expect, but there are going to be challenges for next year. What are other of those headwinds that we keep hearing over and over again, Martin? What do you keep seeing pop up this week, I wonder?
JD, for my money, the two most significant headwinds are going to be U.S. dollar strength and a fading labor market. I'll stick with the first. The U.S. dollar index, which is a great way to look at the strength of the greenback against its global peers, is up about 20% so far this year and trading at the highest levels in more than 2 decades. Against the Japanese yen, the dollar is trading at the highest levels in 32 years. And we're looking at multi-decade highs as well against the euro and the UK pound as well. That's going to act as a headwind to overseas sales for S&P 500 companies. And it has to be remembered, about 40% of revenue is generated outside of the United States for the biggest US companies. And we're hearing reflections of that headwind in virtually every earnings call. So I wouldn't imagine that that's going to abate in the coming quarters. The second issue is going to be discretionary spending linked to both inflation and the labor market. The Fed thinks that the headline unemployment rate, which is about 3.5% right now, might reach 4.4% at the end of next year. That kind of movement just simply cannot occur without a recession. The recession, of course, the depth and breadth of it will be debated, but it will be recession nonetheless if the Fed's projections prove true. So collectively, if the Fed stays ahead of central banks around the world with its rate hike plans, the dollar will remain elevated. And if they remain ahead of other central banks with the rate hike plans, we're probably going to see a decline in labor market strength and an increase in unemployment. Both of those suggest to me that spending is going to be curtailed significantly into next year. That will eat into earnings. So what JP Morgan says, I think, is very likely to bear fruit.
Martin, I want to lean on your expertise because you are without a doubt pretty sure the smartest person I've ever met because you know everything. There's a word that I keep seeing over and over again, and if I have questions about it, then I know our viewers do too. Talk to me about capitulation, because we're hearing about the slippery slope, and there's talk of macro capitulation, investor capitulation, policy capitulation. Help us better understand what that means in terms of context for people that may be seeing that quite a bit and may not have the full perspective about what it means or why it matters to them.
Yes, it's a phrase that does really penetrate financial market jargon, and indeed it's part of the language that professional fund managers use as well. But I have to confess, JD, it's not a phrase that I've ever been a particular fan of, because it suggests that there's a collective and sort of singular direction in terms of investment thesis and strategy across the whole of the investment complex. And I've never bought that to be true. Essentially, what people are talking about when they refer to capitulation is the idea that investors will simply give up. They'll give up the fight against market sort of headwinds, even if they see the momentum moving in a similar direction. So therefore, if with respect to capitulation in equities, it's basically sell as much as you can, get down to a neutral or market neutral level in terms of your equity holdings, build up your cash piles, sit back and wait until you have a better understanding of the macro backdrop. Now, that is probably something that is, I would say, consistent across the investment landscape, but the timing of it is different for nearly everyone because everyone's objectives, of course, are very different as well. So whilst I think you can get capitulation from some of the bigger funds, it's not necessarily something that you see completely across the board, and everybody has a different house view as to whether or not the economy is going to dip into recession in the first place, for how long it may remain in recession, and to what degree it will accelerate out of recession once the trough is complete. So therefore, because you have all of those different expectations and estimations, the timing of capitulation is different for everybody else. For my money, JD, at the moment, I think market volatility is a bigger issue than capitulation, because essentially what we're seeing now are such elevated levels of daily movements that it entices investors out of the marketplace and traders in. You've often heard the term that markets hate instability, that markets do not like sort of indecision, if you will. They prefer certainty. And I think from an investment point, markets absolutely prefer certainty. But from a trading point, people make hay out of uncertainty. And that's certainly what we're seeing now with elevated levels to the VIX, the daily swings that we're seeing in markets, and the fact that we can get sustained rallies of about more than 100 points for the S&P 500 over multiple days, even when there are so many headwinds that are facing us at this time.
Absolutely. Well, as we speak, the S&P is currently just a hair over that 3,700 level. We've been watching in recent weeks dance above and below 36 after the two-day rally. We're briefly in negative territory here, just fractionally or so to start off this Wednesday. We'll continue to follow those numbers very closely. And thank you for that, by the way. Thank you for helping demystify some of the otherwise pretty complicated jargon that I think people come across when they read these sorts of headlines. That's what we're here to do. I do want to get your perspective on something else people will see a lot in the headlines and admittedly may not have a lot of context for. Give us some perspective, because you wrote about this today. Britain's 10.1% inflation reading. What does that tell you about the Bank of England's fight against inflation? I know this wasn't probably the thing you wrote the most about today, but I did see you briefly covering it, because obviously what happens there does impact what happens here and vice versa. But for a bit of perspective, I'm curious what's top of mind for you on that story, because it is an important one.
Yeah, it's been important lately, hasn't it, JD? I mean, typically you will see American investors glide past European data points unless there's something incredibly significant. It's only when something really goes wrong that American financial systems tend to reverberate as a result. Debt crisis in Europe, for instance, the potential exit of Greece from the Eurozone that we saw in 2016, and indeed some other issues as well. But with respect to the United Kingdom, of course, we had that tremendous amount of market volatility following the economic plans of the new Prime Minister Liz Truss, which she put into place at the end of September. Now, it didn't take long for those to be U-turned, of course, and now there's a new finance minister, a whole new set of borrowing and spending plans, and the ship has stabilized a little bit. But the underlying concerns remain, JD, because as you say, we have the fastest inflation in 40 years in the United Kingdom at 10.1%, and some of the fastest food price inflation that we've seen on record. And those are both indications of the economic pain that Britain is going to have to face as a result of its decision to leave the European Union again in 2016. So this is interesting to me, because what it does is it intensifies the Bank of England's fight in order to tame inflation. They're going to have to increase rates at a faster than expected pace, and they're going to have to sell bonds from their portfolio, which they gathered during the quantitative easing process. Both of those are going to be seen as policy tightening, because they absolutely are. But at the same time, the Bank of England, if they are focused on the inflation fight, isn't going to be able to offer any support to the government if it has another economic misstep. And we don't really have a great deal of faith in the new leadership at this point. So if the Fed is focused on inflation and the government makes another mistake, then we could see an echo of the bond market volatility that we saw at the end of last month resurface. And I think you saw some of that today, JD, with benchmark 10-year notes here in the United States rising to 4.11%. That's the highest level since 2008. Now, a great deal of that, of course, is linked to the fact that we expect inflation to accelerate and the Fed to continue raising rates. But a portion of it is linked to the volatility that we saw in Europe last month and concerns that it may resurface. And the inflation figures in Europe were the precursor to that.
Before we move too far off the conversation of macro, I do want to first give you a little bit of a macro curveball here. And I just want you to speak a little bit more about volatility and the bullishness and cautious, not even cautious optimism, caution outright for the future. And I was just sent this. This is JP Morgan global market strategist Marco Kolanovich said yesterday he's remaining bullish through the stock sell-off, now trimming risk for his own model portfolio. The headline at Seeking Alpha says another big bull gets cautious. And to this point about caution, Martin, you and I were talking earlier about this tweet that is now working its way through Twitter from none other than Jeff Bezos, where he says the probabilities in this economy tell you to batten down the hatches. I didn't know specifically if there was anything there on either of those points before we moved on to more specific housing data and things off the macro side that you want to respond to. And are you surprised that Jeff Bezos would take to Twitter with a quick one line like that?
I actually was, JD. I mean, he doesn't insert himself into these discussions in a way that some other billionaires do, not mentioning any names, but Elon Musk. Let me carry on. So I was a little bit surprised to see something as colorful as that from Jeff Bezos. I think batten down the hatches might be a little bit overly pessimistic. I do think that the presumption of recession is one of a shallow and short duration, simply because the Fed seems to have its arms around it at the moment. And indeed, corporate earnings, whilst not blowing the roof off, continue to grow in the third quarter and indeed over the final months of the year. That might give the economy the strength to accelerate into a recovery maybe more quickly than people had anticipated. But I do think caution is absolutely the word of the day. And I point, JD, to the fact that when you have cautious markets that are set against extreme volatility, that's where you have some significant concern. And the one number I think we can all look at today and going forward is the VIX. That's what we refer to very often as the fear gauge. It's a measure of option market volatility over the next 30 days, which sounds pointy-headed, and to some degree it is. But if you distill it down and you take the headline VIX number, which I think is about 32.5, you divide it by 16, and you have the percentage change that markets expect on any given day for the S&P 500. Doing that right now, you get a number that suggests about a 2% daily volatility for that benchmark. And when it's trading at around 3,600, that means intraday swings potentially of about 70 points. That's more than double what we saw in the spring and significantly higher than years when the market was simply climbing in a singular direction. So that's why I really do believe that volatility set against the caution that you described is part of the reason that we may not be able to sustain the rally that was seen over the past 2 days.
Yeah, thanks for addressing that, because again, if people haven't already seen that tweet, I suspect they will in the hours to come. So thank you for letting me get that one in there. I do want to ask you about something else I know you covered this morning at TheStreet.com, Martin. That's housing and mortgage data front and center with focus on this Wednesday. What did we learn from the Mortgage Bankers Association?
That number was really interesting to me, JD. I thought it was going to jump over the 7% mark last week. The MBA basically calculates what they see as mortgage, the average U.S. mortgage rate for a 30-year fixed conforming loan, the most vanilla of all. It did rise to 6.94%. It's still under 7%, but it is rising, and it's up about 100 basis points really since August, which just is an incredible increase in borrowing costs for people trying to get onto the housing market. So I thought that number was significant, and particularly so, JD, when you consider that inventory simply isn't matching demand expectations. People still want to get into the housing market, even though the borrowing costs are rising, but housing starts continue to decline. The housing starts number for the month of September was down 8.1%. Building permits, I think, were down about 5% as well. And both of those numbers were larger declines than anticipated. Now, those numbers can be a little bit misleading because sometimes they always include multifamily construction, which is a bit more volatile than the single family numbers. But the single family home number was down 3.7% last month, and it's down, the last I checked, about 31% from its recent all-time peak. That's a big decline in new projects, suggests incredible caution, as you sort of illustrated in our previous segment with respect to the home builders, and probably doesn't do much in putting new product on the market. And therefore, you can imagine that existing home sale prices will probably hold as a result, even though we're seeing that big increase in borrowing costs. Where does all that pressure go, JD? Into the rental market. Rent prices are continuing to accelerate, and they're an enormous portion of headline CPI inflation. So when you mix this all together, even if you are to see easing in components in the inflation figures going forward, the rent aspect is still going to be pressured upwards because of what we're seeing in the housing market. And that's why it's so difficult to escape these inflationary pressures once they become embedded, as we often talked about, into the broader economy.
You sort of got there with your last answer, but I was hoping to get you to elaborate on a little bit more why it's important to follow the benchmark mortgage rate so closely, even if someone is neither a home buyer nor a potential home buyer. You started to indicate the pressure that the rental market faces, but what does this mean for someone who may be on the outside and say, mortgage isn't even on my plate, these aren't even the things that I'm loosely considering, because there certainly are broader economic impacts, aren't there?
Yeah, I mean, it's a great point, JD, because nothing moves in isolation. I mean, this is what we have to understand about financial markets writ large. There isn't anything, whether it comes to a currency pair or a stock or a bond or a Bitcoin or anything that you'd like to track, nothing moves in isolation. It is almost always, or invariably is always, the result of activities in other assets as well. So someone who is not necessarily active in the housing market needs to understand how significant a pullback in housing construction can be, because it can drive more people into the rental market, or indeed what it might do to the potential for discretionary spending from people who are hoping that the values in their homes will rise, and therefore they will borrow against that increase in order to fund different, maybe home building projects or spending or sending their kid to college or whatever it might be. So the ties that bind this economy are very often centered with a big knot in the housing market at the center. So even if you're not participating in it, there's no question you are affected by it.
And was there any impact from Hurricane Ian, I wonder, in the data, or might that be reflected next month specifically?
I think going forward, JD, and that's such an astute point, the hurricane, of course, hit on the 28th of September, rounded through the Gulf Coast of Florida and up into the southeastern coasts of the United States. It had a significant amount of damage, obviously here in the state of Florida, but also elsewhere, and that is going to entice new home construction in the months ahead. But that's going to be probably short-lived and may end up being more focused on the multifamily as opposed to the single-family dwellings. And of course, a lot of that money is going to come from insurance and federal insurance claims as opposed to new investment from people in and around the construction market. But nonetheless, it will absolutely have an impact, even if it's one that may not last into 2023.
I think I've asked you this next question before as we pivot topics here. What are you watching on Netflix these days?
You know, here's the question, JD. When you are looking for a new program, do you go directly to the streaming service, or do you go to a hub, look for something that you want, and then kind of end up being rather agnostic as to where you'll find it?
That's a good question. I find if there's something specific I want to watch, admittedly, I probably open up Google, I figure out which streaming service is showing it, and then I just pray that I already am a paid subscriber to that particular platform. That's probably how I do it usually. So that means I could go to Amazon Prime. It might take me over to Netflix. Maybe there's something on Disney Plus I wasn't expecting I want to see. I don't know. I think that's usually how I do it. How about you?
Almost exactly the same. And that does raise questions, I think, for all of us. Because I tend to forget where my favorite programs are found, because once I find them and digest them, I've moved on to the next. So the loyalty that we may have previously experienced with streaming platforms, I'm not sure exists in the same way. I could be wrong, but I feel to some degree that we are so astute at finding content that we don't really give the credit perhaps where it deserves in terms of where it's generated.
That's a great point. Well, to this point, Netflix is back, at least kind of. It seems to be, in the headlines say. Anyway, the company added 2.4 million paid subscribers over the quarter. We know that has not been the tale for the company every earnings quarter this year. How big of a beat is this? And I wonder if all of this, most of this, some of this is from the Jeffrey Dahmer series alone, which admittedly I've never watched, but I feel like everywhere I go, people are like, oh, you've watched Dahmer, right? You've watched this show on Netflix. It's like the most amazing thing. I don't know. I'm not familiar with it myself, but I know a lot of people are very excited about it.
Yeah, that wouldn't be my first choice for evening entertainment after a long day's work, but nonetheless, horses for courses as it might be. But JD, these numbers were just fantastic, and I think really they added rocket fuel to a really solid backstory for Netflix over the past 3 months, and that, of course, being the launch of the ad-supported service. But when you are looking at the addition of 2.4 million new subscribers over the 3 month ending in August, which was more than double the street consensus forecast, that's a compelling story in and of itself. But the expectation is another 4.5 million are going to come back to the platform between now and the end of the year, and those growth rates are going to hold or accelerate into 2023. Partly as a result of the streaming service main platform and partly as a result of the ad service platform. Now, Netflix was a little bit ambiguous as to how and when the ad platform will begin generating the kind of revenue that is expected, because the rollout will be slightly longer than first anticipated. But nonetheless, the fact that people are paying the sort of $15 amount right now with such energy suggests that the lower priced ad service will also generate significant interest as well. Netflix still has to crack down on password sharing, of course, there's no question about that. And in order to keep people enticed to stay on the platform and pay that monthly service fee, they're going to have to invest in new content, and that doesn't come cheap either, particularly when borrowing costs are rising so quickly. But the fact that Netflix was able to steady the ship, and they were able to turn around the 1.2 million customers lost over the first half of the year and nearly double that in the third quarter alone, was an absolutely compelling story, and the market's rewarding it right now.
So give me a sense on what the ad-supported platform launch will look like from a user's perspective. I have to imagine it's comparable to Hulu, which just is one of the many, far too many names out there that I also give money to every month, so I have access to their content. But you do watch a lot, whether it's live sports or whatever it is, you get little ad breaks and they're paid sponsors, and invariably because it's streaming, it means the commercial volume is much louder than the regular programming. Different debate and anger point for a different day. But can we expect something like that now to be rolled into Netflix in terms of what it's like for a user on my couch? I put it on. What do you think we'll grow to expect?
Well, that's the great question, and I think we really aren't able to answer just yet. Although we do know about price point, somewhere around the region of $6.99 per month. That undercuts Disney Plus, of course, which is exactly what Netflix wanted to do. But what we need to know is exactly what you're describing, JD, is what is going to be the user experience, at what degree and to what length will the ads have to appear in your platform in order to justify that lower price, and whether or not, of course, customers are going to endure that, or whether they're going to leap to the more expensive ad-free version or simply exit altogether. All of that remains to be seen, but I think the anticipation is it will act as at least a support beam, if you will, to the broader framework of people buying into the Netflix platform. In other words, you hope that if somebody finds that $15 a month is too expensive, they will opt for the half-price version and endure the ads rather than just leave Netflix altogether. If they can engineer that, they'll be doing incredibly well. But underneath that, JD, I was really struck by one dimension of the earnings that I don't think has gotten the attention it deserves. And that is this. Going forward, Netflix is not going to guide investors to their anticipation for subscriber growth. From now on, they're just going to talk about earnings, about margins, and about revenues, but they're not going to give an estimation for subscriber growth. I think that is really telling, and I would say, in some degree, that it's a little bit worrying. The subscriber growth rates and the race to become the streaming platform provider of choice are predicated on those paid additions. And if Netflix is going to shy away from publishing their guidance for it, it tells me one of two things. Either they think the number is too volatile and they don't want to endure the kind of swings and roundabouts that we've seen for Netflix stock this year, or secondarily, that they just don't see the number compelling enough and that their revenue gains from both ads and non-ads are going to be strong enough to offset that. I don't know which is true at the moment, but I do think it's an important change in the way that Netflix communicates to investors, and I don't think that it's been reflected in the share price this morning.
I admit that I had missed this, and I was feverishly looking up while you were talking. So just to clarify, I mean, this really has been one of the most important data points the company has released every earnings call, right? It's not like a lot of other companies where, of course, you'll get top or bottom line figures. It's unique for a company like Netflix. You want to know what the paid subscribers look like, right? That's an indication of a streaming platform's growth, both at home as well as abroad. And you're saying the company sort of also revealed that they're no longer going to be reporting that number that is usually the headline-making figure. Do I have that correct?
Yes, I think they're saying they're not going to guide to it. Now, I have a feeling that they'll probably will find a way to understand what the number will be, but they won't give investors an anticipation of that growth rate heading into the subsequent quarter. They're going to do it one more time. Or actually, no, they're not going to do it one more time. Starting in the fourth quarter, they won't guide any further. So this 4.5 million figure that we're working on now is the final guide that Netflix will offer investors. And again, I just do believe that that's a significant change in their communication, and it's going to change the way, in much the same way that Apple stopped telling us what their unit sales were. This is a way that Netflix is changing their communication with investors.
Well, it's interesting, right? Because presumably it's easier for the company to be very public with aggressively pointing to that figure when it's good. In previous years, when there wasn't as much competition, as we saw earlier this year, the dam can only hold for so long. That's really interesting. I'm glad you brought up, and I wanted to make sure that I got a clarification to make sure that I understood, so our viewers know as well. Martin, thank you for all that. Time now for our rapid fire section. Are you ready for these? Pew, pew, pew. They're going to be fun ones. Okay, first up, let's talk Tesla. We haven't talked Tesla all show. Earnings for the company are on deck. Martin, what are you expecting from the EV giant? That's a great graphic. Look at that. Shout out to our producers. What are you expecting, Martin?
This one's going to be a lot of fun, JD. It may end up being the most important data point that we get for the entire week. The Street's looking for earnings of around $1 a share, up from 62 cents last year, and revenue somewhere in the region, I think if I've got the number right, about 22 billion US dollars. They, of course, had record deliveries over the third quarter of this year, and that's going to engender record revenues as well. But there are so many things underneath that we're going to need to explore. Automotive margins, exactly what the demand picture is in China and elsewhere, where they see a new gigafactory being constructed, which is likely going to break ground sometime in 2023, what the anticipation is for production rates for the semi-truck. There's all sorts of issues from a pure Tesla point of view that need to be ironed through into the final months of the year. And then, of course, JD, exactly what is the expectation for Elon Musk, his purchase of Twitter, which is supposed to close in 8 days, and how that might affect his chances of selling more Tesla stock in order to raise money to buy the company, which of course he has to pay $44 billion for, around $33 billion of which has to come either directly or indirectly from himself. So the expectation is he may need to pump up the expectations for Tesla earnings over the final months of the year in order to sell some stock to help pay for Twitter. If you're still following me, you can understand why this one is going to be so much fun after the closing bell today.
We always follow you as best we can, Martin. So to clarify, you said 8 days there, right? 8 days? We're 8-day Musk watch? Wow. Okay. We will be following in 8 days. Okay, next up, P&G cutting its sales forecast. Moving on with our rapid fire questions. What is weighing on the company, Martin?
Not much more than the US dollar, which has just been an incredible headwind for brand companies around the world, and you know, nobody more so than Procter & Gamble. You know, everything from Bounty tissue paper to Tide and all the rest of it. They are suffering from an ability to repatriate overseas revenues as a result of the strength of the dollar, and to some degree are hitting their head on the ceiling of price increases that consumers can bear in this inflationary environment. Now, all that said, they had a pretty solid quarter, $1.57 per share. They had revenues of about 20.8 billion US dollars. Both of those beat the Street, and the expectation for organic sales between now and the end of their fiscal year, which ends in 2023, was held in place. They see it growing at about 5 to 6%. When I say organic, I mean sales that are stripped away from any currency movements. But because of that US dollar headwind, they actually see their all-in sales declining between 1 and 3% when compared to the fiscal year that ended in 2022. And that's a significant change. The stock was performing reasonably well in the face of that, and I guess that does suggest some optimism that they can carry on passing on price increases to their customer base. But that dollar headwind is rearing its head, and companies that don't have that kind of pricing power are going to suffer much more greatly than P&G as a result.
Yeah, we saw those challenges with repatriation with a strong U.S. dollar from names like Salesforce and many others. What an important reminder on a morning like this, what companies are challenged with. Okay, next up, number 3 here, United Airlines riding the travel boom. My goodness, are they ever? Get your passports out if you got them, folks. Can it keep this up, though, Martin?
I mean, this is a really interesting one. And Scott Kirby, the CEO of United Airlines, said something that I thought was fascinating. He said that given the state of hybrid and work from home environments at the moment, every weekend is a long weekend. People are able to travel much more frequently and much more freely without having to race back on Sunday afternoon in order to be in the office on Monday morning. So that's expanded the travel boom, which is riding on a wave that really we haven't seen since prior to the pandemic, and is giving a big boost to United Airlines earnings. They beat on the top and bottom line, record revenues of $12.9 billion for those 3 months ending in September, and a bottom line of about $2.81 per share. They see profits growing significantly into the final quarter of this year as well, more than double street estimates. And they see the revenue per available seat mile, TSRAM is how it's referred to, rising about 25% from 2019 levels, not just from the prior pandemic years. That's a really significant change, and again suggests that not only are we having this kind of travel boom, but that United and the other carriers are able to hold down their cost base in order to ensure that they can generate revenue from from passengers for each available seat, and then turn that into better than expected earnings. And they've been doing that reasonably well over the past 2 or 3 quarters, and they say it's going to continue into the end of the year and beyond.
And number 4, finally, most importantly, but it is important, World Series matchup. Who do you like? Please don't say Philly.
Well, it was a Miami Marlin that helped you out last night, wasn't it, JD, with that 3-run hit from Giancarlo Stanton? Of course, not bitter at all that he's left my team to play for yours, but nonetheless, I'm glad to see him doing so well. But I mean, I guess the question, JD, is who would you think makes a better World Series opponent for the Yankees? Is it the Padres or is it the Phillies?
I mean, Phillies would be a rematch of 09. San Diego would be a rematch of 98. So there's nice history there. I'd probably like to see Philly because I went to college in Philadelphia. You see I'm wearing my pinstripes today to celebrate Game 1 today at Houston. So I'll go Yankees, I guess Yankees, Phillies.
How about with respect to
though?
Baseball, JD? What do you think the officials and the TV people would prefer? Those West Coast games are so difficult for the broader portion of the U.S. audience. Do you reckon that there would be that bias towards having 2 East Coast teams in order to maximize the television revenue that a series like that would bring?
See, that is a thinking man's response and a thinking man's question. Most of us are here in 2022, and you are like 10 years in the future. It's a great question. It should be a great series. We got Jameson Taillon throwing tonight out on the mound. Any predictions before we wrap up?
Predictions, no, but I'm actually hopeful for a San Diego win, to be perfectly honest. I'd like to see some new blood. And I would like to see San Diego get their full revenge over the Dodgers for all the money that they spent over the summertime trying to capture that market in Southern California. It's been such a tremendous battle, just replete with bitterness and recrimination as well, which is just exactly the kind of drama that I want from my sports.
Absolutely. No shortage of fun storylines. The best part of the football season is here. Baseball playoffs just heating up. And we get to do this again every morning here on our broadcast. Martin Baccardax, thanks for taking the time. Thanks for helping us give context to a really busy and important trading morning. Martin, thank you.
Thanks, JD.
All right, man. See you tomorrow. That's going to do it for the Market Open here for the floor of the New York Stock Exchange. Stick with the street for more on these and all of the major market stories that matter to you. We'll see you tomorrow.